But let's go ahead and take a look at bonds. So we're about to roll over to the uh, June contract. So let's go ahead and look at that. I think there's a pretty good probability that we either completed a primary cycle low or maybe have a little bit more of a drop to hit. So we could see maybe 30-year bonds dropping to the 116 and a half zone. Maybe tag this lower Bollinger Band. We are in the time band for a primary cycle low, and going to discuss that standard deviation price theory in more depth. Explain that for you in the mastermind course, but looking for that to be tagged in the coming days. So I think we want to be buying the next dip here in bonds. Take a look at the June contract for the 10-year. Perhaps a drop into the low 109s is sufficient for that bottom to be complete. But if you compare that to where we are in the March contract, that could take us to this lower Bollinger Band here, which is well, actually it's the high 108s area. So it could get one more final washout here. It was looking good on Friday. We made a new low, closed up on the day. We had some bullish divergence. I still want to avoid seeing an oversold reading on the RSI indicator during this pullback. I think that is not that much to ask from bonds right now. The big thing we need to be worried about is the potential breakdown from this inverted saucer formation. Crude oil seeing a nice bid today. That's not helping the bond rally. I still have some positions in the energy sector, in Liberty Energy, FTI, and Petrobras. But if we start to, really break down here, I don't know that we're going to get those rate cuts. So bonds, especially in the long end of the curve, need to bottom. They are due for a bottom.